All right, let's look at the Treasury yield curve. This is a site called Guru Focus. I was just looking around at the Treasury, the yield curve news, and the yield curve steepening. And so we'll take a look at what that means and how it works. So this is for Treasury bonds, U.S. Treasury bonds. And for 1 month right now, it's 13%. And for the 30-year, it's 1.68%. And this is sort of a normal thing for the yields to increase as you have a longer time span. You'll get a bigger return on a 30-year treasury bond than on a 1 month. And here's what the yield curve has done. 2018, 2019, it started getting weird looking. And here you can see the spread between the 10-year and the 1-year. And so generally before a recession, you'll get a spread that is upside down. This is called like an inverted yield. And then it steepens through the recession. That's the pattern we usually get, and it'll usually go inverted down here, and then it'll steepen through the recession and past it, and then it'll flatten back out. And so that's the 1 versus the 10. Here's the 2 versus the 10. And so the last several recessions, it's gone inverted, and then it's gone steep through the recession. Here, inverted, steep, and then this is a really cool chart here. So let's do this. Let's just run through it. This is like a little animation that kind of shows the yield curves. And so this is starting in 1967. And you can see as it runs into the recession, it goes from flat to steep, and it stays steep for a little while, flattens out, and sometimes goes inverted, and then it'll go steep into the recession, and it'll stay steep for a while, and then it'll start to flatten out, inverted, steep, inverted, right, and then it goes steep again, and it'll stay steep for a little while afterwards, and then the yield curve will start to flatten out again, coming into the recession, and then it'll get steep, right? When the recession hits, it's steep, and you can see the treasury rates used to be a little higher than they are now, on average, 5% or something, and then here it's getting flat again, and inverted, and then bang, steep into the recession, and then it stays steep for a while. And the spread here is from like 1 to 5%, and then it's flattening out, inverted, and then goes steep into the recession, and then stays steep. I think it stays steep for a while here. This is the long bull run that we had, running up. Yeah, and it's zero interest rate policy. The bottom of the yield curve is near zero, tops around 2-3%, something like that. And it starts flattening out here, again, inverted, and bang, steep. So we just got a steepened yield curve this month. So generally, after you get that flattened inverted yield curve, and then right when it steepens out, that's usually right when you're coming into a big recession in terms of the yield curve. And then if you look at the rates will kind of tell you how, I guess, how deep to expect the recession to be. I was listening to Raul Powell talk about the yield curve rates, and he is looking for interest rates to actually go negative and then steepen from negative interest rates, which would indicate like a long-term kind of depression, deflationary scenario. But what we're getting now is close to zero, and then it's steepening. It looks steep, but it's only steepening up to less than 2% here on the 30-year. And so this just stretched out. A bunch of people were getting out of the 20 and 30 years, and so they just kind of popped up here, but we're not at negative rates right now. It's still positive, not very positive. So this just indicates that maybe we're just coming into a recession now, and that the rates are low. So this looks like a slow recovery, but it doesn't look like a depressionary crash from these rates. Like if it was a negative interest rate yield curve that was getting steep, that would indicate like kind of the depression deflationary scenario. And this is like a recessionary kind of indicator here, but not deflationary or inflationary really. That's just a recessionary kind of indicator. And if you click back here a little bit, you can see where the yield curve kind of flattened out, and it didn't flip upside down, completely upside down. Yeah, and then it steepened back out. So some of these, some of these previous recessions, I can get it to go over here. It would invert, like the yield curve would go upside down, where the longer ones have a smaller yield than the short terms. And then people say that the inverted yield curve like that is a big indicator of a recession, which has been sort of true, except that the recession hasn't happened while the yield curve is inverted. The recession hits bang right there when it gets steep again. When the yield curve steepens, that's when you're in it. Like that steepened yield curve after the inversion is when the recession starts. And then it stays steep for a while as you come out of it. And that's kind of the pattern. And here, see, it's inverted. It starts to flatten out. It goes inverted. And then it gets steep in the recession. And then it'll stay steep afterwards. So that's kind of the yield curve pattern to look at. And so we didn't go completely inverted. It started to kind of flip, but it did just steepen out now. And so, not that it's the exact same, basically our financial system has changed a little bit, reconnecting like the Fed to all the Eurodollar international banks, and things aren't exactly the same now in the international monetary system, because the Fed is doing some crazy stuff. And just more of the same kind of stuff. But that's a look at the yield curve and the interest rates. And the Fed funds rate now is low, near zero, and you can see the short dated Treasury bonds are low, and that's pretty common for the for like the 1 month or 3 month Treasuries to be close to the Fed funds. And yeah, these charts are helpful that show you sort of the steepening or the inversion. The 10 to 2 year spread is a good one. And so when it's going down, especially when it gets below zero, it's actually inverted here. So if it's close to zero, it's kind of flattening out, and down here is inverted. And then you can see it starts to steepen. It gets more steep through and after the recession, and then it'll flatten out again. And so that's kind of the pattern that we've been getting, on the whole way down as the interest rates have been coming down. It'll usually invert and steepen. So that's the steepening yield curve, and the steepening yield curve after it's flat or after it's inverted is more of a recession indicator than the inverted yield curve itself. Like the inverted yield curve, when it starts to flatten out and invert, that means that there's a high probability that a recession or something is coming soon. But when you're actually in it, you get the steep curve. And then let me hop over to Treasury Direct, and I can talk about the treasuries a little bit. So this is treasurydirect.gov, and this is where you can directly buy treasury bonds. And what a treasury bond is you're loaning money to the federal government, and what they do is it locks your money up inside of basically a savings account at the Fed, and then at the end of a certain time period, they'll give you your money back plus whatever interest rate when you bought the treasuries. So you can just go to Treasury Direct, go to My Account, and then you can open an account. And when you open a Treasury Direct account, it's basically a savings account at the Fed. And this is, the interest rates are tiny right now, close to zero. But this is basically the bank that has the smallest counterparty risk. Like the Fed has almost no risk of going, I mean, it's technically can't go bankrupt. I mean, I guess there's some case where the country could decide to end the Fed, and I don't know what would happen to the treasury accounts and stuff in that case. Um, but as far as like a bank going bankrupt or bailing your money in or some crazy stuff like that, in terms of counterparty risk, there's no such thing as a bail-in at the Fed. I mean, they can just create the money to pay you your amount plus your uh, tiny bit of interest. But but yeah, TreasuryDirect.gov. If you want to get Treasury bonds, so if you do Treasuries in like a brokerage account, you're not actually buying Treasuries. You're you have like a contract for Treasuries that you can trade back and forth with other people. But then you have counterparty risk at the brokerage, and the brokerage may or may not even actually own or control the treasuries. They get traded in and out of like the repo market, and it could be like a whole chain of different banks or something that have some sort of claim to the treasuries. And um, trading like treasuries in a brokerage account, there's a bunch of different kinds of counterparty risk. And if you get treasuries here at the Fed, like this is your actual account at the Fed, and yeah, this is like the smallest amount of counterparty risk you can have on a savings account. So if you want to just leave cash sitting around, and this is not financial advice, but yeah, this is where I just stick cash if I don't want to use it for a while. And well, I mean, 0% interest rate's not that attractive as an investment. Um, but if you're trying to avoid, risk, and you and you think that holding cash with the inflation rate that we have now is something that you want to do, like in the case of Warren Buffett or something like that, where he's selling things and holding cash. He thinks, probably that taking a loss on cash in the short term is a better deal than holding stuff that he thinks is going to crash. So he's been selling things and holding cash. And yeah, and anyways, this is just one way of holding cash with the least counterparty risk, um, in my opinion. And that's the inverted yield curve. And when it steepens, when the yield curve goes from flat or inverted to steep, that's generally when you're entering into uh, a recession. And so I don't know what that means in terms of the stock market at the moment. I mean, the stock market's going crazy right now. Um, but I mean, it's obvious. I mean, it's pretty obvious that we're in a recession now. People are debating whether it's a depression or not. The whole world has been shut down now, and it's just it's a really complicated thing between the other currencies and the dollar right now. Um, but yeah, it's a worldwide recession right now, and people are just kind of trying to figure out how the currencies are matching with other currencies. Like right now, people are moving out of U.S. Treasuries, and maybe this has something to do with all the social unrest in America. Like people started coming all to America for Treasury bonds and stuff like that, and now the whole society is going crazy. Maybe that's hurting some confidence in the U.S. as sort of a safe haven, but people are moving out of U.S. Treasuries now, and we're getting a steepened yield curve. Yeah, and the DXY is pushing down right now. So that's yeah, it's sort of an inflation indicator, and we're not at negative rates. We have a steepened yield curve above negative rates, and so um, that's a slight inflation indicator, I guess, which is probably a good thing. Um, but also also indicating that we're in a recession, um, and the rates are low, so it's not an indicator of like a sharp recovery out of the recession or anything right now. But yeah, that's just to look at the treasuries, and kind of how you can use the treasuries to predict the economy, but doesn't necessarily mean you can use the economy to predict what the stock market is doing, because the stock market's it's been crazy. Um, but yeah, as far as the actual economy goes, right now this is indicating that um, it's indicating a slow recovery. It's indicating that we are in a recession now and a slow recovery, and this is something to watch month to month. Um, like the manufacturing indexes came up and they came in pretty close to the same, a little bit higher than last month. So that's a recession indicator, and the yield curve is steepening now, but it's steepening at positive rates. So like if it had dropped to negative rates and it steepened with negative rates, then that would be a deflationary, like depression indicator. And yeah, so just something to keep a look at. These treasury bonds are really predictive of what's going on in the economy, and yeah, and that's definitely not worst case scenario for the treasuries right now. Um, but we'll have to see. We'll have to see what they do if the rates go more positive or more negative, and you can use that to really the direction and the steepness of the curve and how it changes month to month. You can kind of get an outlook as to whether things are looking deflationary or inflationary. If everything starts pushing up and getting steeper and going up, like the bottom end of the curve, everything is moving up, then that's an inflation indicator. And if it moves up, significantly, that would be a high inflation indicator. And so, yeah, I think that's one of the best indicators that you can have as far as the real economy goes. Um, but as far as the stock market, I've still been listening to everybody's theories on sort of inflation or deflation in the stock market and how the money is actually getting into the stock market and the prices. Because the Fed has announced they're going to buy bonds and all that sort of thing, but they haven't really changed much. Like they have their purchase sheet, and the Fed's not directly dumping any money into the markets, and the banks are still contracting and giving out less loans. Um, and buybacks have continued to decrease. So like all the things that were previously putting more money into the market are not aren't. There's uh, the general methods that money has gone into the market over the last 10 years are decreasing and continuing to decrease. Um, but the prices in the market are going up, and the low interest rates might have something to do with it, as people don't want to hang on to cash right now. And I've heard a lot of theories about other countries. Other countries are going to negative rates, and so the bonds and the equities in their countries are looking scary, and so that maybe would indicate that the U.S. is a safe haven asset, and there's money coming from other countries, and then all the swap lines where the U.S. government has opened up swap lines with a bunch of countries like Canada, Mexico, like the EU, England, Sweden, Denmark, Norway, um, Korea. Those are all the positive swap line countries who have a direct connection to the Fed where they can trade their currency directly for US dollars to pay their loans because there's a big dollar squeeze across the world. Whereas countries like China are not getting a swap line, and so the US government, the Fed can kind of lean on those countries and not help them with their dollar squeeze. Um, and that's kind of the currency wars that are going on right now, kind of who wants to play nice. I think Brazil has a positive swap line now. Um, and so, they make deals to get a positive swap line to help them out with their dollar debt situation. Um, but those countries that have the positive swap line have access. They're like first in line to get dollars, and they can pay their debts. And so, it's those kind of countries like the whole EU area and things like that, where those rates are starting to go negative, in the EU, and the US has positive rates, and now they can get access to dollars, and a ton of this Fed money printing is looking like it's going into these different international banks and like shoring up their funds for people to default on all their loans and all that stuff. So it seems to me like most of the trillions of dollars that are being printed are to go into the dollars being destroyed out of the international banking system. And um, who knows? I mean, who knows if they're printing not enough or too much, and if that money is coming back into the U.S. But that's the best kind of idea that I've seen as to where extra money would be coming from into the U.S. stock market would be kind of the swap lines and just the investment accounts and the hedge funds and everything and other countries uh, just readjusting away from cash assets that are going negative and away from their equities that are looking at negative bond yields in their countries and stuff like that. Could be a flow of money into the U.S. stock market. But this steepening yield curve, with everyone selling the long dated bonds now, looks like it might be a move uh, away from the U.S. dollar. And so this will be a big week to kind of track the U.S. dollar and the DXY and sort of the bond trading and try to figure out the pattern of what's going on and what direction the bonds are going, and try to predict where the interest rates are going to go, to try to get an outlook on the economy. And I'll keep working on the macro theories. Man, there's just every freaking thing you could think of. People are saying all kinds of stuff. Nobody knows what's going on. All these macro professionals, um, nobody knows what's happening right now. Things are just absolutely crazy. But I'll try to aggregate that stuff together and get the best information I can available. And yeah, and so this is a good one, the steepening yield curve, and happy trading.